Hello, everybody. Welcome to another episode of Erickson TV. Curtis here with Lauren. Hello, Lauren.
Hey, everybody.
Hey, Lauren. We've talked quite a few past videos about the ebbs and flows into mutual funds, and what we mean by that is going back to 2008 when the markets, the equity markets went significantly lower. The mutual fund outflows from equity funds has been very consistent almost every year, all the way through last year, in fact.
Right.
And then so the article, and then everybody has been moving their money into the bond funds during the same time.
Which would be normal if it was just 2000 and 2008.
Right.
Not good,
right,
but normal. I mean, that's normally what people do. But it's really abnormal that it just keeps happening.
Right. I agree. So, and then we would all agree that just about any equity investment that a person had last year would look pretty good. It had a good return. Doesn't really matter
Everything
where you're at.
went up.
Went up.
If you somehow lost money in the stock market last year, you should really talk to us.
Right. Exactly. So they kind of blame part of last year's outflow with this worry about the fiscal cliff, negotiations, and then they said, okay, going into January of 2013, because they came up with sort of a last-second, short-term compromise on the fiscal cliff negotiations, people actually then did put some net inflows back into mutual funds for equities. And then what was interesting is that there was a small amount of net positive inflow into equities in February, and then March, there's a bit of a nice little bump up. So really, this first quarter of 2013 was the first time in many, many years that we had a material positive net inflow into stock mutual funds.
Now that we've had years of positive returns, and you missed out on those.
So I thought that was pretty good. But the interesting thing was, even with all what this is going on, for the first quarter, the bond fund inflow was still much higher than the equity inflow for this first quarter of 2013.
Okay.
So what that's telling me is people are still looking for yield.
Right.
And what that also is telling me is that people are still behaving based on current news and fear and fear of that. So the takeaway for people that have maybe been moving their money in and out of these type of things, what would you tell them?
Find a strategy and stick with it. Figure out what your risk tolerance is, how much money you can stand to have in both stocks and bonds through thick and thin, through the worst time periods and the best time periods, and then stick with it. Don't move it around because of how you feel or because of what the news says. In particularly, don't move it around because of what the news says.
And to finish this episode off, inevitably, for the rest of this year, you're going to see something in the media saying, watch out, you should not be in stocks because of the European situation or whatever the situation is.
Or alternatively, here's some random stock we chose that's going to do brilliantly this year.
Or here's a better investment alternative. I'll finish this episode off now, but our next episode after this, we're going to talk about the irrational case of stockophobia.
All right.
So that'll be your next episode. So thank you for watching this episode of Erickson TV. Bye now.
See you next time.